Though, with our talk of the tape, a risk-off atmosphere. That is what former Dallas Fed President Richard Fisher told me we are in now, and it's likely to stay that way. Our first guest, he agrees. He just doubled down on his crash call for stocks. Let's bring in Cantor's Johnston. He's with me once again, and that's really what it is. It's a call that stocks are going to crash from here, that they have a lot more downside, right?
They do have a lot more downside. I think our conviction at this level is as high as it was when we were 1,000 points higher when we were bearish at the beginning of the year, bearish at 4,300 and now at 3,780. And the reason why, even though price level is down and our conviction is super high right now, is based on what's going on in a number of different areas, including the rates market. So I think yesterday was very important. Powell backed up his Jackson Hole comments with action, not only going 75 basis points, but also saying the Fed funds rate is going above 4%, and he understands that could cause a recession. He actually probably wants a recession in order to get inflation down. And I think if we take a step back and really understand the magnitude of how important this rate move is, over the last 12 years, the Fed funds rate has been above 1% for only 1 year. Okay, so this economy, investors, businesses have become accustomed to interest rate at suppressed levels for the last 12 years. Now we're talking about a Fed funds rate of 4.5%, the highest in 15 years, real yields, which is what dictates how much risk people take, the highest in 15 years, and the 2-year yield is surging. So what are the implications of this? And I don't think at all they have been that they've hit the equity markets yet, because all of the downside in the equity markets has been due to higher rates, not due to the implications of what I'm about to say, which is that when you think about the impact of these higher rates, it's from companies refinancing as their debt comes due. They're paying the higher rates. The access to credit, the ability to actually find the ability to borrow. They're thinking about doing a project. The whole calculus around whether to do the project or not is going to be impacted by rates. And then my final point here, just before we move on, is that looking at money market funds right now are yielding almost 4%. They're about 3.3.
Right. I know where you're going with this. I know where you're going with this. But I mean, if we get everything out at the first, we don't have a conversation. I mean, I want to go through some of the points that you make, not to lay out your whole case and then we have nothing to discuss. I find it hard to believe that you're as bearish today with as much conviction as you had when we were 1,000 points higher. How can that possibly be true? And also, if everything you say is so crystal clear to seemingly everybody, why didn't the market get destroyed today after what Powell said yesterday and what the Fed did and what they're likely to do moving forward?
Sure. So in January of this year, when the S&P was at 4,700, we were still doing QE. The Fed funds rate was at 0, and the economy was still very strong. And so we made the prediction and bet at that time that those things were going to roll over and those things were going to happen. But the magnitude of where we are now is far greater than what I think anyone really could have expected in terms of where the Fed funds rate is going so quickly. To your question around why hasn't not been reflected in equities yet, in my view, when this information is known, I think it's a great question. One of the things that has held up the equity markets is that the individual investor still has not sold. Institutional investors have. And I think, we talk about one of the risks to the upside is that institutional investors are very underweight now equities. But the individual investor who piled $1.7 trillion into the market has not sold yet. And as price starts to continue to go down and as money market yields go up, I think that's going to change.
So I want to try and have a conversation, too, about the other side of the coin, right?
Scott, just to be fair, if you ask me, based on this current information, where the S&P would be, I would tell you that we should be much lower. I'm very surprised that we have not sold off as yet, but I think it's coming.